Texas Roadhouse officially beat consensus for Q2 2026.
Yeah, a really solid beat all around.
Right. They reported top-line revenue of $1.68 billion, which topped the $1.67 billion estimate.
And the bottom line looked just as strong.
Exactly. They delivered an earnings per share of $1.85, edging past that $1.83 consensus.
Which, in this environment is no small feat.
Definitely not. And looking ahead, management actually lowered their full-year commodity inflation guidance.
Down to approximately 5%, I think.
Yeah, down from that previous 6 to 7% range. They also updated their effective tax rate to roughly 14%.
While still maintaining that massive capital expenditure target.
Right, that $400 million CapEx budget to fund about 35 new company-owned openings.
And Wall Street loved it.
They really did. The stock reacted positively, jumping 2.19% in after hours, trading to $212.73.
Pushing it right back up near its 52-week high of $213.26.
Okay, let's unpack this. Because Texas Roadhouse just broke their internal revenue records, but, and here is the wild part we need to explore today, they're doing it by actively choosing to absorb the pain of record-high beef prices.
Yeah, rather than just passing all those costs entirely onto you, the consumer.
Right. So the mission for this deep dive is to dissect exactly how they achieved this top-line beat. We want to look at what mechanisms they're using to defy the broader restaurant industry's struggles, and, most importantly, what vulnerabilities are hiding underneath the hood of those massive revenue figures.
Because for anyone holding this stock in their portfolio, or, even if you just track the consumer discretionary space closely, this quarter's print serves as a masterclass in operational leverage.
It really does.
You're looking at a company navigating some just brutal cross-currents in casual dining. I mean, consumer wallets are tightening, food costs are incredibly volatile.
Put it mildly.
Right. And yet, they are pulling operational levers that their mid-sized competitors simply cannot access. To really understand the engine driving this, you have to look past that $1.68 billion headline number and look at the actual composition of the foot traffic.
Because the revenue drivers here are genuinely fascinating. We're looking at same-store sales growing an impressive 6.2% year over year.
Which, by the way, represents the 5th consecutive quarter of double-digit comparable sales growth.
5 quarters. And it's not just, inflation-driven menu pricing artificially inflating those numbers.
Well, not at all.
They saw a 3.0% increase in pure guest traffic alongside a 3.2% increase in average check size.
So they're getting this nearly perfectly balanced contribution from both, right? More people physically walking through the doors and those people spending slightly more once they sit down.
Which is wild.
Yeah. In the current macroeconomic environment, getting an extra 3% of human beings to actually show up and eat in your dining room rather than just squeezing your existing customer base for a few extra bucks is exceptionally rare.
It's basically unheard of right now. And the volume they are pushing through these boxes is just staggering. Average weekly sales broke the $175,000 threshold for the first time in the company's 33-year history.
Just massive throughput.
System-wide, they hit over $177,000 per week. And if you look purely at the company-run locations, that number jumps to over $183,000.
Plus, we can't forget the to-go orders.
Oh, right. Their to-go sales have remained highly sticky at 13.3% of total sales.
Meaning they are doing over $25,000 a week in pure takeout volume per restaurant.
Which, okay, that volume creates a massive logistical puzzle. I mean, dining rooms are physically finite spaces.
Very true.
You only have so many tables, and you only have so many prime hours during a Friday night dinner rush. So if you're already running these jam-packed steakhouses, my operating theory is that cramming 3% more human traffic into that exact same square footage should require either breaking the laws of physics or completely burning out your waitstaff.
Yeah, it sounds impossible on paper.
Right. So how do you push that much extra volume without the operational model collapsing in on itself?
What's fascinating here is how they are fundamentally decoupling labor hours from guest volume through technology.
Okay, unpack that.
So historically, the restaurant business operates on a strict linear scale. If you bring in 3% more guests, you generally need to schedule 3% more front-of-house and back-of-house staff just to maintain your ticket times and service standards.
Makes sense. More people equals more work.
Exactly. But the real standout metric in this report is that despite a 3% bump in physical traffic, their labor hours only grew by 0.8%.
Wow. Wait, so they're achieving nearly 4 times the traffic growth compared to the labor hours they're adding.
Yes, they're basically turning the restaurant floor into a highly optimized assembly line.
So if a server isn't, say, walking back and forth to a central point-of-sale terminal to run a credit card, you're cutting out those empty miles they walk during a shift.
That is the exact mechanism at play here. They have aggressively rolled out digital kitchen screens and these pay-at-the-table platforms.
Ah, right.
Think about the friction points in a traditional dining experience. A table finishes eating, they wait for the check, the server brings the folio, the guest puts down a card, the server takes it to a terminal, prints the receipt, brings it back.
Which can take, what, 5 to 7 minutes easily?
Exactly.
Mhm.
Pay at the table eliminates that entirely. And meanwhile, the digital kitchen screens streamline the expo window, which reduces those bottlenecks when food is plated and just sitting there waiting to be run out.
So you shave 5 minutes off every single table turn.
Multiply that across 100 tables
Huh.
over a 5-hour dinner rush, and you've suddenly created the capacity to seat dozens of extra parties.
Yeah.
And you did it without adding a single square foot to the building or hiring an extra server.
It's a massive structural efficiency game,
Huge.
which sounds like it should be an absolute goldmine for profitability. But, this brings us to a glaring disconnect in the earnings report. Top-line sales are breaking records, they're unlocking these massive labor efficiencies, and yet the bottom-line earnings per share actually decreased slightly year over year.
Yeah, down 0.7%.
Right. And even more telling, their restaurant-level operating margins fell by 66 basis points down to 16.4%. So if the technology is working that well, why is the bottom line shrinking?
Well, because the physical laws of a restaurant might bend to technology, but the biological laws of the commodity market do not.
Oh, the beef prices.
Exactly. The top line is booming, but the bottom line is being heavily compressed by the cost of goods sold. Specifically, their food and beverage costs spiked 136 basis points to 35.4% of total sales.
That's a huge jump.
They absorbed a massive 7% hit from commodity inflation in Q2 alone. And the primary culprit driving this is the structural shortage in the domestic cattle herd.
Right. For those tracking the agricultural space, this cattle shortage is a multi-year crisis. Watching Texas Roadhouse's revenue growth right now feels like watching someone sprint on a treadmill that just keeps accelerating.
That's a perfect way to describe it.
Because beef costs are skyrocketing, they have to sell significantly more steaks, turn more tables, and push their staff harder every single day just to tread water on their earnings. So, what does this all mean? Explain the mechanics of this cattle cycle, because it's not like a supply chain issue where you can just open a new factory, right?
Right. Unlike poultry, where you can ramp up chicken production in a matter of weeks, the cattle cycle takes years. During the severe droughts a few years ago, feed became incredibly expensive. So ranchers were forced into liquidating their herds, sending even their breeding females to slaughter just to cut costs.
Which artificially spiked supply back then, but...
But ruins the future supply.
Right.
Now that conditions have slightly improved and ranchers want to rebuild their herds, they have to hold back the young females, the heifers, from slaughter so they can breed.
So paradoxically, the decision to rebuild the future herd violently shrinks the immediate supply of beef going to the packers today.
Precisely. The domestic cattle inventory is at its lowest level in decades, which pushes the cost of raw beef to astronomical highs. Steakhouse concepts are completely exposed to this cycle. Honestly, the only reason Texas Roadhouse's margin compression wasn't disastrous is because of that 40 basis point improvement in labor costs we discussed earlier.
So the tech efficiencies literally subsidize the beef inflation.
100%.
So the obvious question becomes, if beef is eating your margins alive, why aren't they just aggressively jacking up menu prices to protect the bottom line?
Yeah, you'd think they would.
I mean, almost every other major chain in the casual dining space is pushing heavy price increases onto the consumer right now. Wall Street usually demands instant margin protection, yet management announced they are only taking a highly conservative 1% menu price increase at the start of Q4.
Targeting a total pricing leverage of just 2.9% for the year.
Right. So why willingly take that margin hit?
Because they are executing a strategy we can call the scale as a moat thesis. Mid-sized competitors and independent mom-and-pop steakhouses are being absolutely crushed by these record beef costs right now.
Because they don't have the buying power.
Exactly. An independent operator buys beef on the weekly spot market. When wholesale ribeye prices surge, they have no choice but to raise their menu prices by 8% or 10% just to keep the lights on.
But Texas Roadhouse...
Conversely, Texas Roadhouse leverages its massive national scale to negotiate multi-million-dollar long-term forward contracts with the major meat packers. They have a built-in cost advantage before the steak even hits the grill.
Which gives them the luxury of choice. They can choose to keep their prices relatively flat, while the competitor across the street is forced to make their menu prohibitively expensive.
That is the core of their everyday value proposition. Management knows that the consumer is incredibly price-sensitive right now. If a family sees the local independent steakhouse charging $35 for a steak and Texas Roadhouse is charging $22, that family is going to shift their dining habits.
Texas Roadhouse is actively choosing to absorb some of the commodity pain to buy long-term customer loyalty.
And permanently capture market share. They are playing a multi-year game, sacrificing short-term margin padding for long-term dominance in the steakhouse category.
That level of discipline is rare, especially when you're facing quarterly earnings pressure from analysts. But investors obviously want to know when the margin relief is actually coming. Looking at management's forward-looking commentary, when do these raw commodity costs start to ease up enough to let those tech efficiencies finally flow through to the bottom line?
Well, we are starting to see the very early signs of stabilization. Management noted some near-term relief, specifically in sirloin prices. They updated their guidance to show that Q3 commodity inflation is tracking much softer, around 2% to 3%.
Well, that's a nice drop from 7%.
Yeah, before they expect it to tick back up to roughly 5% in Q4. But that temporary dip in Q3 provides a vital breather for their operating margins, allowing the unit-level economics to catch up to the top-line growth.
And that margin breather is syncing up with what looks like continued aggressive revenue momentum. Management noted that Q3 is off to an incredibly hot start.
Really hot.
For the first 5 weeks of the quarter, same-store sales are tracking at positive 6.2%, and average weekly sales are holding remarkably strong at $168,000.
Holding that kind of volume through the late summer months is a strong indicator of demand inelasticity, especially considering summer seasonality can often cause dips in dine-in traffic.
Right, people are on vacation grilling in the backyard.
Exactly. But the most revealing part of management's commentary wasn't just the current sales, it was their aggressive development outlook.
Right, the 5% to 6% store week growth.
With a pipeline that includes roughly 35 new company-owned openings this year alone, that capital expenditure breaks down to about 20 core Texas Roadhouse locations, 10 Bubba's 33 locations, and 4 Jaggers.
Let's pause on Bubba's 33 for a second, because the underlying data shows that concept is becoming a serious growth engine. The sources point out they're hitting $129,000 in average weekly sales at those locations, which proves they can replicate their operational success outside of just steaks.
Oh, definitely. It's a strong secondary engine.
But I have to push back on this broader expansion strategy for a minute. We are looking at a consumer base that is being squeezed by inflation, discretionary income is super tight, and yet management is maintaining a massive $400 million CapEx budget to step on the gas with 35 new, massive footprint restaurants.
Sounds aggressive.
Right. From a capital allocation standpoint, isn't rapidly expanding during a precarious economic cycle incredibly risky?
It looks risky on the surface, but if we connect this to the bigger picture of commercial real estate, this is a highly calculated, opportunistic land grab.
Okay, how so?
Management has firmly outlined a long-term unit target of approximately 900 restaurants for the core brand. They already have their development pipeline secured all the way through 2029. Think about the leverage they have right now.
Because other brands are struggling.
Exactly. Many capital-constrained restaurant concepts are freezing their expansion plans because borrowing costs are high and construction costs are inflated. Real estate developers are sitting on empty out parcels in strip malls, desperate for reliable, high-volume anchor tenants.
Ah. So Texas Roadhouse walks into those negotiations holding all the cards. They can demand prime real estate placement and highly favorable long-term lease terms simply because they are one of the few brands actually writing checks right now.
That is exactly the dynamic playing out.
Yeah.
They are leveraging their pristine balance sheet to build out the footprint that will generate cash for the next 2 decades. It's the classic contrarian playbook. Expand aggressively and secure prime territory while your competitors are retreating.
So the $400 million in CapEx is heavy today, but it permanently locks in structural real estate advantages for tomorrow.
Spot on.
Well, to give you, the listener, a fully balanced view of this earnings print, we can't just focus on management's contrarian optimism. We have to look at the structural headwinds and run a valuation reality check because the market is pricing in a lot of future success.
Yeah.
Let's start with the operational risks management explicitly called out, particularly around the calendar shifts.
Yeah, calendar shifts are one of those mechanical nuances in retail and hospitality that often catch amateur investors completely off guard.
Right, because it sounds trivial until you look at the math.
Exactly. Management specifically noted that Halloween and Christmas holiday shifts this year are modeled to shave about 75 basis points off Q4 same-store sales.
That is 0.75% carved right out of their revenue growth simply because of where dates fall on the calendar.
And the mechanics of that are brutal for a high-volume chain.
Right, like if Halloween falls on a Tuesday, kids trick or treat and maybe families order a quick pizza. But if Halloween falls on a Friday or Saturday night, which are traditionally a steakhouse's most profitable, highest volume shifts of the entire week, you lose that prime dinner rush entirely.
Yep. Families are out in the neighborhoods, not sitting in a booth ordering ribeyes.
And the same logic applies to Christmas Eve and Christmas Day falling on weekends.
It completely hollows out the weekend revenue model. Analysts have to manually adjust their Q4 models for that 75 basis point hit so they aren't spooked by what will otherwise look like a sudden deceleration in same-store sales.
Right. Good to know.
But beyond the quirks of the calendar, you also have to monitor the rising overhead costs required to fuel this expansion. General and administrative expenses, the corporate overhead, are growing in the low double digits. Furthermore, depreciation is up in the low teens.
The depreciation drag on the income statement is a very real consequence of that $400 million CapEx budget. I mean, building 35 new stores is capital intensive, and the accounting depreciation from those physical assets will weigh down net income figures for years.
That's unavoidable.
But the most polarizing risk here might just be the stock's valuation itself. We're seeing a massive divergence in how the market views this company.
The splitting consensus is really stark. Traditional Wall Street analysts loved this print and aggressively upgraded their price targets. Piper Sandler bumped their target to $208, UBS took it to $235, and Bank of America was the most bullish, raising their target all the way up to $276.
So they're looking at the traffic growth and the real estate land grab and projecting massive future cash flows.
Yes. But if you strip away the analyst narratives and just look at the quantitative models, the picture changes entirely. Platforms like Investing Pro, which rely purely on algorithmic fair value metrics, are heavily flagging the stock as overvalued.
Overvalued, what's the multiple?
It is currently trading at a steep price-to-earnings ratio of roughly 33.8 times.
Wow. For a mature brick-and-mortar restaurant chain, trading at nearly 34 times earnings implies that the market is pricing in absolute perfection. There is zero margin of safety at that multiple.
Zero. When a stock is priced for flawless execution, any slight deviation from the narrative can cause a severe multiple contraction.
Yeah.
If traffic decelerates from 3% down to 1%, or if the cattle cycle takes an unexpected turn for the worse and beef costs spike another 10%, a stock trading at 34 times earnings will get punished mercilessly by the market.
You're basically buying in at the absolute peak of expectations.
Exactly.
And, there's a behavioral economics angle to this traffic growth that I think the bullish analysts might be overlooking. We talked about how Texas Roadhouse is a relative bargain compared to independent steakhouses, but they're also benefiting from a massive value gap compared to grocery stores.
Oh, this is a great point.
Right now, retail grocery beef prices are astronomical. If you go to the supermarket, look at the price of a raw, uncooked ribeye and factor in the time to cook it and clean up. Suddenly paying $22 to have someone else cook it and serve it to you with 2 sides at Texas Roadhouse looks like a brilliant financial decision.
They are acting as an inflation hedge for the middle-class consumer.
Precisely. But what happens if retail beef prices at the grocery store suddenly drop?
This raises an important question regarding the sustainability of their current traffic surge. If that grocery value gap closes, meaning the supply chain normalizes, and it suddenly becomes cheap to buy high-quality beef at the supermarket again, the psychological calculus for the consumer flips.
Right.
The moment eating at home becomes significantly cheaper than dining out again, Texas Roadhouse is at risk of losing that specific subset of customers who are currently using them merely as a refuge from inflation. That 3% pure traffic growth could evaporate overnight.
Which means defending their current premium valuation is completely dependent on their ability to flawlessly execute the unit expansion and maximize their technology rollout to offset any potential loss in that value-seeking traffic.
It creates a fascinating tension for anyone holding the stock. Texas Roadhouse successfully squeezed incredible operational leverage out of their new technology shading minutes, off-table turns with pay-at-the-table platforms to successfully offset crushing inflation this quarter.
It's impressive.
But technology adoption is ultimately a one-time step up in efficiency. You can only eliminate those physical friction points once. You can't make a table turn in 0 minutes.
True.
When they run out of easy digital upgrades next year, will their steadfast commitment to conservative menu pricing become a trap if the biological realities of the beef cycle turn vicious once again?
For more rapid-fire deep dives into the numbers that move the market, make sure to follow the show for your daily earnings coverage. See you tomorrow.